headline inflation has been coming down quite precipitously. But it's also fair to say we're nowhere near yet at the central bank targets. Welcome to Key Points for March. This month we ask, why are things looking a little less bad in Europe? We look at the interest rate expectations and why investors are now less optimistic about rate cuts. And we focus on the breakout we're seeing in equity markets pretty much wherever we look. Now, turning to our first point. Last month we had focused on the US and the fact that the economy was more robust there. Now sadly that can't be said for the Eurozone, but nonetheless the way we see it is that things are looking a little bit less bad. Unemployment in the Eurozone is still at record lows and wage growth is pretty healthy, and this is allowing consumers to consume. But one of the things that is going under the radar, we think, right now is what's happening with energy prices. If you look at the chart I'm showing you here, you remember, of course, when the Ukraine war broke out, energy prices spiked. There was concerns about rationing. But what's happened in the last year or so is that they've continually fallen. Actually, if you look what's happened in the last year alone, electricity prices and gas prices are down about 50% in the last year. And if you look very closely at the last couple of months, year to date, they're down 25%. So this is important, of course, because not only does this mean that households and companies will be spending less money in terms of energy, but it also means some of the pressure on inflation is going to be coming off as well. This has been a massive force in bringing headline inflation down, and it shows you we're not yet complete. There is still further downside ahead. Now, turning to our second point around rate expectations. I had mentioned, of course, that headline inflation has been coming down quite precipitously, but it's also fair to say we're nowhere near yet at the central bank targets. And one of the reasons for that has been that actually the service part of the economy and wages are still running at too hot a pace. If you look at the chart I'm showing you here, whether it's in the US, the Eurozone or the UK, the service component of CPI is running well above the 2% target. And if you look just at the latest data point that's come out, it's actually ticked a little bit higher, not ticking lower. And that's a concern, and that's one of the reasons why these central banks are still speaking with a relatively hawkish tone. Now, what's interesting about that is this is now being reflected in terms of market pricing of when the first rate cuts are. The chart I'm showing you here is looking at the Fed Fund futures, and the dotted line shows you what the market expectations were at the end of last year, just a couple of months ago. And the market was expecting actually the first rate cut to happen in March. It was almost 100% priced for that. And the market was also expecting a further 6 rate cuts over the course of this year. Now that's changed partly because of these higher service inflation readings that we're seeing. Yes, the market is still expecting rates to be cut, but the first rate cut is not really expected now till the summer months, and only 3 rate cuts are expected for the course of this year. And this is something that we would agree with. We still believe that these central banks have to be hawkish in terms of their tone in order to really make sure that they're bringing not down just down headline inflation, but the service component also comes down as well. Now, turning to our third point, can the breakout we're seeing in equity markets continue? Well, you might remember last month I spoke about the S&P 500 in the US and the fact that it broke out to new 2-year highs, and the idea being once you get these breakouts, momentum can last for a bit longer, and indeed that's what we've seen. But I think what's really interesting this month is look what's happened to this red line. This is the Japanese Nikkei 225 index. And what you can see here, it's broken out as well, but not to a new 2-year high. It's taken 34 years for this market to break above the levels it was back then. And again, this has been a long period of consolidation. Back in those days, Japan was really a bubble market. It was trading at 60 plus times earnings. Now it's only at 16 times. It's had been out of favor for a very long time, certainly in relation to the United States. But now things have begun to get a little bit better. Corporate Japan is focusing on shareholder value again, and we've seen momentum begin to pick up. So breaking to these new highs, we think the market has perhaps a bit further to go. But broadly speaking, given the massive move we've seen in equity markets over the last 6 months, perhaps a pause that refreshes is something that we should be watching. But nonetheless, over the longer term, we still think there's upside potential for equities. Now remember, as always, you can read the full report, Investment Insights, on our website, and we look forward to seeing you again next month.